Phil McKee. Hope you guys have had a good week so far. And today we are going to go over a monstrous dividend yield, and that would be the Cornerstone Strategic Value Fund. I know that this is something that a lot of you closed-end fund investors are looking at, and I have seen that a lot of people have talked about it, but they haven't really broken down, the fund and into the level that I'm going to get into. Some of them have kind of touched on it, but it is a monstrous dividend yield, as I just said, at 25%. And if you had looked at it perhaps maybe even last week, it was nearing 27%, which is just ridiculous to think about. Now, I think that this could be a powerful vehicle in your portfolio, but I don't think it should be the biggest, and I'm going to discuss that right now in this video. So, as always, like, comment, and subscribe, and leave any thoughts below. But first of all, why should we even look at this fund? Why, first of all, something this high is what people, refer to as a yield trap. So why should we look at this fund? Well, let me break that down for you. So first, it should increase the overall dividend yield in your portfolio. So if you use this as sort of a, less risky position, say 4 to 5% of your portfolio, you could really make this basically a holding that would boost your overall yield a couple of percent. Now, that people would say, oh, well, it's still a yield trap. Yeah, but it's 5%, and it would boost that yield, and there's a lot of tax benefits, which I'll cover later. Obviously, there's a 25.8% yield, and it's consistently paid dividends since 2003. Now, this fund has had some murky water since 1987 to like 2002 or so. If you look at their distribution dividend history, in the beginning, they were paying once a year, and it was like $50, $60 a dividend. The fund was worth like $100 at some point, which, perhaps a lot of things have happened then, and I don't have much information on that time. But now when we look at the funds and the holdings, it makes a lot more sense. And part of the reason it makes a lot more sense is because it's down 40% from where it was usually trading in the last 5 years. So that's obviously, either a very big red flag or, a green flag. And there's a reason it's a green flag, which I also want to kind of touch on. But for the most part, right now it's at a 10% premium to net asset value. And net asset value, for those of you that don't know, is the value of the assets, the underlying assets that is in a fund. So if there's a fund such as CLM that holds, tons of different stocks, generally these closed-end funds trade at a discount or a premium to the net asset value. Meaning, if you hold the fund, you can buy the fund for more than what the assets are worth or less. However, there are funds that, like CLM, traded at a premium for most of the time throughout history. And generally, for CLM, that's been a 30% premium. But right now, it's only 10%. So, we might have 20% upside there. Plus, you might be able to lock in that yield. So, like I said, it is a 25% yield. I'm not going to lie to you and tell you it's like the last video, which is Jeppy. It has medium volatility. As we see over the last 5 years, it's dropped 47%. But in that time, it was yielding around 15%. So, you kind of have to look at that at both sides. If it's, depreciating itself about 5% a year, you can lock in 10% a year, essentially, which kind of mirrors SPY, but, kind of underperforms SPY. So this is fun. This is a fund that I would err on caution with a little bit. So I would look at it and get into it at points that make sense. I wouldn't just buy and hold or just continually put money into the fund. And the reason for that is essentially because they do a rights offering every single year, and that's part of the reason that the fund has dropped 40%. When they do this rights offering, what it means is that investors are able to purchase the fund's shares at a much lower, price than the current net asset value, or at net asset value. I believe it's 112% of the net asset value that you can purchase the fund at. So generally, like, the net asset value is always below. There's a 30% premium. So if they can buy it for 112%, of the net asset value, these investors are able to get the fund at a killing price. Now, a lot of people have dumped their shares because of this. Obviously, let's say you have a 30% premium and people are able to buy it. Let's say it's a $15 or a $10 fund. The net asset value is $7. People are able to buy it at $7 plus, 12% of $7. I'm not that great at math off the top of my head, but that's still probably, let's say, $8, and the fund is $10. So that's a $2 discount, 20% discount about. So you can check my math there, but that's the general idea, and that's what the rights offering does, and that's the reason that it's dropped 40% for those of you that see that. So let's get into how this fund yields 25%, as I just kind of rambled on the rails over there. But the fund's investment objective is to seek long-term capital appreciation through investment in equity securities of U.S. and non-U.S. companies. Now, as always, these funds put in a little note that says there is no insurance that this fund will achieve its investment objectives. in determining which securities to buy for the fund's portfolio. The fund's investment advisor uses a balanced approach. It kind of details, value and growth and, how they invest in their stocks and how they pick their stocks. And they do have some very good holdings, which is what I want to kind of cover in this video. So you will see some of the holdings as I go into the next slide. So as you can see here, great companies, no? Apple, Amazon, Microsoft, Alphabet, Berkshire Hathaway, UNH, Tesla, Nvidia, Visa, Energy Select. These are all holdings that are generally, looked at as, they're in the S&P 500 for the most part. And they're looked at as solid companies with solid history, solid balance sheets. So there's a reason that people are always wondering, why is this, if this fund is holding all of these stocks, why is it dropping so much? And that's what I kind of wanted to describe in the beginning of the video. These are all good holdings. So why is the fund dropping? And that is kind of based on how the fund is designed. So first, let's go over the ratings of most of these stocks, debts, equity, securities that this fund holds. As you can see, here's the breakdown of the credit quality. We've got almost 40%, I'd say, in AAA and AA, and then we've got some lower tiered. I think that seeing that AAA and that AA is a lot more, like, it's able to comfort you a bit, because you think about it and you can see that, like, okay, 40% of it is well-rated securities, so you're able to see that and understand that, okay, the other 60% might be a little riskier, but that's kind of how they're able to get that 25% yield. And of course, the not rated is what threw me off a bit. Like, what does that mean? Where can we see more information about that? And I wasn't able to find that in my research. So I want to break down now the most recent distribution that was announced for June 30th. It says June 30th, 2021, but this still applies to the distribution that's coming out this month on the 30th. It's one and the same. I don't know why they haven't put it as 2022 or if this is just from last year, but let's go ahead and break this down for sake of example. So the source of payment is kind of a description of how the fund is able to generate this, dividend. So the first one is the net investment income. That would be the income, the dividends and like however other securities they hold, the actual income from those securities. The second is the short-term cap gains. That is what they're basically returning your capital to you. And the long-term cap gains is them returning your capital to you as well on those stocks that they're buying and selling. And the last thing, a lot of people haven't covered this, but what the paid-in capital is it is the capital that is a return from the rights offering. So like I said earlier, every year in this fund, there is a rights offering that takes place. What this does is, again, it's a kind of win-win scenario. So investors are able to buy it at 112% of net asset value, and basically the stock share kind of falls, which is kind of not a win, but it's a win in the sense that they're able to keep this distribution high because they give you, a significant part of that distribution in paid-in capital, which is the money coming back to you every year from that initial rights offering. And generally, they announce the same dividend, and that dividend just goes throughout the year. The next year, they declare the next dividend. That remains the same throughout the year. And it kind of works like that with the rights offering. Now, for those of you that don't know about return of capital, which is essentially long-term cap gains, short-term cap gains, and the paid-in capital, it can be a tax-efficient way to get a pretty nice way of income and not pay as much taxes on it. Again, I'm not a tax advisor, so I would do your own research, but based on what I've been told and from what my own brokerage has given me statements of throughout some of their material that they publish, it is a way to lower your tax obligations to the government. And that's always nice if you're someone who's looking to, either fat fire or, what that essentially is retire early or retire or trying to go into retirement, to base your portfolio based on this. So the last thing I want to cover is my personal holding in CLM. I think it'd be a little disingenuous if I didn't put this into the video, as I'm not, personally in it, and why am I making a video on it? Unless I thought it was, compelling and I didn't have money to put in at the time. But my current holding in CLM is about 50,000, which is about 8.2% of my portfolio. And, when we look at that from a perspective, it's slightly high, but I would limit myself in my portfolio to between, maybe 8 to 10% max, just to boost that yield a little more. Again, I'm taking a higher risk with this play, but you can see that my P&L is not too bad because I bought it at the low. And that's what you have to do with CLM. You have to buy it at the low and, sell it at the high, as you should with any investment. But with this, there's the unique opportunity of that rights offering every single year, which may give you the opportunity to buy in low and sell high and lock in a dividend for that year, if you're somebody that can once a year, kind of look at it. And currently, it's making me about $1,000 a month, so I can't complain from $50,000. That's quite a lot. So I hope this video has been pretty clarifying. I tried to bring my best and most of the information that hasn't been covered by others. So if you did like the video, I'd appreciate a like and comment with any questions you have. I always respond within 24 hours. And yeah, subscribe for more amazing videos and more dividend stocks and more portfolio breakdowns. So cheers. You guys have a blessed day, and I hope to see you guys in the next video.